In San Francisco, and this is Bloomberg Technology. Coming up, Amazon reports earnings with sales from Amazon Web Services surging nearly 50%. We'll have full coverage and analysis over the next hour. Plus, $120 billion wiped off Facebook's market cap in a snap after earnings disappoint. This is the largest single loss for a single company in history. Investors weigh in. And tech earnings continue to roll through, with Spotify also reporting. We will discuss where new users are coming from and how the company is fighting off competition from Apple and Amazon. But first, to our top story. Amazon reported better than expected results in the second quarter and forecast more of the same in the current one. Investors were a little perplexed by the numbers. Shares were teetering in positive and negative territory in aftermarket trading. The company missed analyst estimates on revenue and revenue forecasts, but revenue growth from Amazon Web Services and advertising were both strong, and the company beat massively on earnings. The results and outlook show Amazon is managing to keep a lid on expenses while investing heavily in new devices and businesses like selling groceries and prescription drugs. Joining us now, Guru Hariharan, CEO of the e-commerce platform Boomerang, also a former exec at Amazon and working on the supply chain and retail merchandising. Also with us, Jitendra Rawal of Bloomberg Intelligence, who covers the company for us. Jitendra, you were pretty excited about these earnings. Why?
So if you actually look at the profit beat was massive by every standard. If you look at every segment, AWS, North America retail, international retail, margins improved across the board. And one of the key things that jumped out was, if you look at the advertising revenues, that last quarter they started reporting it under the other with the new accounting change, continues to be strong, 130% growth in that segment. So a combination of these advertising plus the fulfillment by Amazon program picking up and private label goods, these are helping margins, and that's driving this monster beat on earnings.
The CFO on the call talked about how the company is improving efficiency basically across the board, even as they're making these big investments, Guru, in Alexa, in grocery, in prescription drugs.
Yeah, so right now Amazon's achieving a big snowball effect. They're starting to build some big momentum. But if they look forward, there are about 3 plays that they have to really perfect. Number one is like a very defense play that they have to play in the cloud services businesses. There's competitors coming in, like Microsoft is making a big acquisition and closing up with developers by acquiring GitHub, and then Google going big on their cloud businesses. So they have to play defense over there. But there are 2 other areas where they can play massive offense and gain a lot of revenue and margins. Number one is, as Jitendra said, AMS, Amazon Marketing Services. And that's a very high profile and a high margin business for Amazon. It's growing very rapidly, as it's a very measurable technique for consumer packaged goods to start getting in front of shoppers. The other is the grocery business, which, having acquired Whole Foods, and that's starting to pick up momentum, and they're integrating those 2 businesses, as we saw even in Prime Day, that's a very big $800 billion opportunity, a revenue opportunity for Amazon to capture.
Also, Amazon saying on the call that Whole Foods is driving new Prime memberships, and that on Prime Day they saw more new subscriptions than ever, despite that big glitch. Jitendra?
Yeah, I think the pace is accelerating at a smaller than expected pace, to be honest. But like Harry said, it's actually a very a big market and very low penetration right now. So the opportunity is there. They just have to build the infrastructure around it first.
Guru, are there any red flags?
I don't see many red flags at this point. Even the slower revenue growth is just it could be a strategy in terms of starting to capitalize on some of the profitability levers that Amazon is starting to create because of the Prime membership and because of their ability to capture a lot of customers in a very sticky way and all that. And that allows them to start reinvesting all that back into R&D. And we saw that the R&D expense again went up pretty significantly. And that just allows Amazon to create a very significant competitive mode in the long run.
So, Jitendra, would you agree? Do you not see as many challenges ahead?
Well, we talk about tax challenges, we talk about regulatory challenges, the overarching ones. But
and
when it comes to the business,
this is the quarter in which President Trump has taken Taking aim at Amazon, for sure.
Absolutely. But if you look at the core business, especially the marketing services business, I mean, what we are seeing is Google and Facebook go after the traditional digital advertising dollars, right? But Amazon can actually go after both. They can go after the retail traditional digital advertising dollars, but they also can go on the trade promotions bucket. So basically, they can grow without actually directly competing with Google and Facebook in a lot of ways. And if you look at their traffic on their platforms in the US, they're getting pretty close to where Google and Facebook are. So they have the ad inventory, and we have seen Alibaba do this successfully in China. So we see, rapid growth coming in profits from advertising.
What about international, Guru? They talked about improving efficiency in Europe, in Japan, as they continue to invest heavily in India.
India is a big growth segment for them. And we also saw that the head of India is now the part of the senior team at Amazon. With having missed the boat in China, they're very serious about India. Developing country, they also announced a big entry into Australia. They had some bumps in the road with that, but there's a big market to be had over there. Europe continues to be very strong for them, but a lot more developed than the other countries. But all these vehicles that we're talking about in terms of whether it be advertising, whether it be Prime, subscribe and save, and consumer packaged goods and grocery, these are all significant amount of opportunities, not just US, but international.
What about Prime Video, Jitendra? How big an opportunity is that? We see it's a huge opportunity, obviously, for Netflix, but with Amazon, it's been a smaller contributor to the business. The division has had a lot of struggles lately. Where does Prime Video go from here?
I mean, the strategy there is to really preempt entrance of Prime, right? So Prime Video is available in 200 countries and territories globally. Prime in its true glory is available in 16. So what they're trying to do is use original content and things like that to attract more people onto the Prime bandwagon. The hits so far are missing, largely, but the investments are there. They're going up, and hopefully some of the originals that they're investing in work.
Guru?
I think from a Prime Video, it's a very, again, good growth channel for them. Amazon's been known for books, music, video, and DVD. That's where they started their business. But sort of now with the 2.0 version of that, and they're reinventing and being the category king in those, whether it be video or whether it be books with Kindle, it's a very big opportunity for them to grow a very high gross margin profile revenue business.
This as Amazon continues to chase Apple for that $1 trillion market cap finish line. Jitendra Rawal of Bloomberg Intelligence, Guru Hariharan, Boomerang, thank you both.
Thanks, thank you.
Okay, coming up, the New York Times is reporting that special counsel Robert Mueller is specifically scrutinizing tweets and negative statements from President Trump about Attorney General Jeff Sessions and the former FBI Director James Comey. The Times also reports Mueller is examining whether the president's actions add up to attempts to obstruct the investigation by both intimidating witnesses and pressuring senior law enforcement officials to tamp down the inquiry. This news comes following word Wednesday that 11 conservative Republican House members introduced articles of impeachment against Deputy Attorney General Rod Rosenstein, the official who oversees Mueller's Russia investigation. Coming up, Intel reports for the first time since the sudden departure of CEO Brian Krzanich in June. We will bring you all the highlights. And if you like Bloomberg News, check us out on the radio, listen on the Bloomberg Radio app, Bloomberg.com, and in the U.S. on SiriusXM. This is Bloomberg. Intel also reported results after the close Thursday and gave an upbeat forecast for sales, signaling the company is staying competitive even after the abrupt departure of CEO Brian Krzanich in June. For more, let's bring in our Bloomberg Markets correspondent, Romain Bostic in New York. Romain, what are the highlights here?
Well, I mean, they beat estimates pretty much. I mean, look at it this way. I mean, the company came out last month. They basically gave guidance. Analysts set their expectations based on that guidance. And today, Intel pretty much came in either at that guidance or slightly above it. Unfortunately, you don't actually get rewarded in this market for coming in at guidance anymore. This is a growth market. People are looking for growth stocks. And I think what Intel gave the market today was certainly reassuring in some respects, but not necessarily enough to generate enthusiasm.
Well, and there's continued concerns about a slowdown ahead. This as the company is looking for a new CEO in the midst of a pretty dramatic scandal.
Yeah, I mean, the fact that they didn't really say a whole lot about what the future of that top spot is going to be, it's obviously going to take them some time, given how abrupt the departure was last month. But until people get a better sense of not only who's going to lead the company, but really what the direction is going to be. None of the analysts really out there seem to be all that down on the strategy that the company had before, we got to the end of June. But since then, I think there's been a lot of questions as to whether this can be an opportunity to sort of steer the company in a much more aggressive direction so that they can really keep that lead that they have on some of their smaller competitors like AMD and like NVIDIA.
Ariane King just got off the phone with the interim CEO, Bob Swan, who talked about overall performance. He said we had a fantastic quarter again. We've been accelerating in the transformation from a PC to a data-centric company so we could power the world in billions of connected devices. From the edge all the way to the cloud, this quarter is another indication of the momentum we are building on that journey. So, again, no mention of that big hole to fill. But we are seeing these earnings on the back of that Qualcomm and NXP deal falling through, rising trade tensions, and, an uncertain future for the chip sector overall. Where does Intel fit into that?
Well, it's kind of interesting, though, today. I mean, there is a little bit of enthusiasm that you saw for the chip sector as a whole. I mean, think about today when you had the NASDAQ down 1%, you had the Philadelphia Semiconductor Index that was up about 1.8%. In fact, of the 30 stocks in that index, you only had 7 or 8 that were down, and Intel was one of those companies. So that tells you a lot about how people view the chip sector right now. People are looking for growth, and they see that in a company like AMD. They see that to a certain extent in NVIDIA. Now, Intel is still, the 800-pound gorilla in a lot of ways, but it's not growing as fast. And now maybe it's not fair to put that on their shoulders, given the size that they are, but that's really where investors are looking right now. They want to find the next big thing. They see that in some of these other companies. They don't necessarily see that in Intel. Intel will continue to sort of move along, and it will dominate certain sectors. But I think going forward, if you want to see a real pop in this stock, higher than what it is, it's up about 13% this year. But that's really lagging what you're seeing in the broader market and what you're seeing from some of its competitors.
All right, got to talk about Facebook, that huge plunge we saw right after earnings, after market hours, continuing today. What do you make of the fact that Facebook couldn't recover, and this is the single biggest drop for a company ever?
Yeah, I mean, it was quite remarkable. I mean, a very momentous day for all the wrong reasons. And look, we were talking a lot in the newsroom today about the idea of why people didn't expect this. To have an 18-19% drop in a stock of this, stature, to take people off guard like that raises questions. Did Zuckerberg and Sandberg, did they guide the street well enough to let them know that this was coming? Or was it analysts that really dropped the ball and not really taking seriously some of the issues that we saw out of the Cambridge Analytica scandal? But keep in mind, there are still a lot of analysts that are out there defending this stock today. You only had really 3 downgrades, and one of those downgrades was basically from a strong buy to a buy. So you still have a lot of analysts out there defending the stock. They still think as a long-term play, the dominance of Facebook and the sort of almost near monopoly they have in the space that they operate in will continue to sort of serve them well. They're going to have to work through these things. I think it's certainly possible you're going to see a little bit of bidding back into this stock. You saw that towards the tail end of the trading session, as you saw some bidders come back in that last 15, 20 minutes. We'll see what happens as the next few days and weeks go by. Keep in mind, it took only 2 weeks for them to sort of shake off the Cambridge Analytica scandal. And, for a stock that's now, around $172 a share, it's still well above where it was when it hit that low in March at around 152.
I interviewed early Facebook investor Roger McNamee, who, as you know, has been incredibly critical of Facebook, and even he was surprised by this big drop. And he also suggested that this could be the trigger that leads to a much, much bigger market correction. Would you agree?
Well, I mean, it's the 4th largest stock in the NASDAQ 100, and, it's a pretty large weighting in the S&P. I think the one encouraging sign, though, you had today is that you didn't see the type of contagion. I mean, even when you saw earlier in the day Twitter was down pretty significantly, but some of that had to do with issues that were unrelated to Facebook. And then you saw stocks like Spotify and Pandora and Yelp held up pretty well. So, it's certainly plausible that this could trigger some concern, particularly when you look at the earnings we got out of Amazon today, which, while good, aren't generating the type of enthusiasm. There is certainly a narrative here that this sector as a whole, the broader tech sector, the FANGs, have sort of peaked or have reached some sort of saturation or maturity level that is going to have to be reckoned with. It's certainly possible then that could lead us to a correction, given how much of a weighting these stocks have in the broader market.
All right. Well, we and you, I know, are watching Bloomberg's Romaine Bostick, as always. Thanks so much. And we are going to be speaking with Intel's interim CEO, Bob Swan, tomorrow about these results. Be sure to tune in for that. Another story we are watching, U.S. Federal Communications Commission Chair Ajit Pai said he stands by his agency's decision to send Sinclair's acquisition of Tribune to an administration hearing, even though President Trump slammed the move as sad and unfair. Pai had questioned the legality of the $3.9 billion deal, which would have involved spinning off TV stations in order to meet ownership limits. The deal will now be brought before an administrative hearing judge, which can delay or even kill a deal. Coming up, Facebook saw its biggest one-day drop ever Thursday after the company reported slowing user growth in its second quarter results. We'll hear from an investor who's pushed back on the company's actions in the past. That's Roger McNamee. This is Bloomberg. Investors are reeling from Facebook's disappointing earnings driven by slowing user growth. So the slide in Thursday's session marked the largest single loss for a single company in history. I spoke earlier with early Facebook investor Roger McNamee, and here's what he had to say about the big red flag.
I do think they are running out of users in their most profitable markets. And secondly, I do believe that the weight of the scandals over the past year is beginning to show up in user behavior.
For more reaction, we're joined by Natasha Lamb, Managing Director at Arjuna Capital, a shareholder in Facebook who's spoken out in the past about the power held by Mark Zuckerberg. Natasha, how much does this hurt?
It hurts a lot, and it's not the first time this year. I think that Facebook was pretty, lucky to see the recovery after the Cambridge Analytica scandal. But, we've been calling on the company to acknowledge the risks that it faced, to really face them head on. These are not new problems. What we saw in earnings was really the fallout from, what we've seen in terms of corporate governance, platform manipulation, whether that's been election interference, fake news, and the hate speech, sexual harassment, and violence that's being propagated over the platform. It's pretty notable that we've now seen, twice in 1 year, an over $100 billion loss in shareholder value. And really, I think due to issues that could have been addressed more proactively and earlier on.
What did you make of the earnings call where you had Mark Zuckerberg talking about a solid quarter, pumping up Instagram, and then you had the bombshells from CFO Dave Wehner talking about currency headwinds and the fact that people actually are changing their privacy settings and blaming it in part on GDPR?
Well, I think it's a good time, when there's some negative news to pile on all of the news and really let investors more fully understand the risks that Facebook has faced all along. And I think, Facebook is in over its head. We've got operating expenditures growing faster than revenue, which is never a good thing. But, the fact that OPEX is up 140% year over year, headcount's up 40%. All of those actually seem like necessary investments, given that Facebook needs to fundamentally address some issues with the platform. But where we really start to get concerned is on the revenue side. You bring up the new regulation in Europe and how that's affecting users. And we're starting to see active daily users go down in Europe. And so really, both the erosion of trust and the regulatory risk that we've been talking about coming into play. And I do think there's a huge erosion of trust just because of the timing between, some of these issues like election interference, between when investors were asking for answers, when the company actually knew that there was a problem, and when the public and users discovered that there was a problem. I mean, it was nearly a year, at least, from when we started flagging it before, we 9 months later learned that 126 million Americans were viewing Russian propaganda over the platform in the lead up to the U.S. presidential election. And then 4 months later, Cambridge Analytica with that 87 million Americans data that was compromised. So that's a lot to kind of have to fix, I think, going forward. And even in their developed markets, I think the next step is really to rebuild that trust.
Now, as you say, a lot to digest. Revenue still growing over 40% year over year, despite all of these negative headwinds. Take a listen to what Roger McNamee, early Facebook investor who's been very outspoken about the privacy issues in particular, how he talked about what investors are grappling with.
There's a lot of growth opportunity. The issue is what PE multiple are investors going to put on that, given that Facebook's underlying business model is really based on promoting disinformation and hate speech and things like that, not because Facebook approves of disinformation or hate speech, but rather because those are the things that generate the most engagement.
Now, McNamee also told me he thinks Facebook is not unlike Philip Morris when you think about the harm it inflicts on people. It's quite a dramatic comparison. Natasha, what do you think?
I mean, when we start to talk about issues of addiction, I think we can probably almost universally agree that people are addicted to their smartphones. And that, the kind of information that's being viewed over Facebook is, often not that great. And we know for a fact that there's have been these huge fake news flows. We know for a fact that hate speech is an issue, and that sexual harassment that's being propagated online and over these platforms is an issue. So all of that being said, those things are outside of the company's own terms of service. So when users sign up, that's not what they're supposed to be doing, and the company, has been incredibly culpable in terms of letting that go on. And I think what Roger McNamee was saying is that that's been a benefit.
We're going to have to leave it there. We could go on and on. Natasha Lamb, Arjuna Capital. Thanks so much. Coming up, Amazon shot past all the FANG stocks in post-market trading. We'll bring you the latest. This is Bloomberg. This is Bloomberg Technology. I'm Emily Chang in San Francisco. Back to our top story. Amazon out with better than expected earnings in the second quarter. The company brought in sales of $52.9 billion, above their own target, but trailing analyst estimates. AWS, the cloud computing division, is showing solid momentum with revenue growing 49% year over year. Meantime, the nascent new ad business is showing promise as well, and subscription services, which are mostly from Amazon Prime memberships, rose 57%. Joining us now from San Diego, Reality Shares CEO Eric Irvin. Reality Shares is an innovative asset management firm, ETF issuer, and index provider that has Amazon among its biggest holdings. Also with us in New York, Bloomberg Tech's Garrett DeVink. So, Garrett, I know you've been listening in on the call. We're getting some new information about Amazon, and it seems overall that the company was more efficient across the board and was able to squeeze even more profit from all of its divisions.
Yes, and the profit forecast for the next quarter was quite above expectations, and the main reason for that right now seems to be that third-party merchants, so these are the people who, do not necessarily, are not, it's not Amazon selling you products through the website, but it's actually people, you might have your own store and you go on to Amazon as sort of a shop front. Those third-party merchants are selling more, and so that's kind of why the revenue was sort of just flatlining a bit, but in terms of the actual margin, the profit that Amazon takes from that, because there's a lot less work that they need to do for those transactions, that's why it's growing.
Eric, is this what you want to see? Everything you want to see?
Yeah, absolutely. And really something to look forward to in the future is Amazon, all of that cost and infrastructure and all those expenses that we've seen over the years in the past, now they're starting to bear fruit, right? We're seeing revenue maybe flat or up, flat for Amazon, but up around 35%, and yet earnings are up almost 500% in the last year. So, this is exactly what you want from a business like this, innovation, and then that leads to profit margin expansion.
Garrett, Amazon still has, a lot to work on in some of these new businesses it's expanding into. Obviously, they bought PillPack, trying to break into prescription drugs for $1 billion. What do we expect to see there?
In terms of PillPack, that's probably going to take some time. I spoke to some people, earlier after the acquisition happened who are close to the founders, and the plan that was presented to them from Jeff Bezos seemed to be the one that they were most excited about. There was obviously interest from Walmart for that acquisition, as well as an unnamed pharmaceutical company, but the founders felt that Amazon's plan was the one that kind of aligned the most with what they wanted. So there's definitely going to be something interesting coming from Amazon on that, and obviously prescription drugs, huge market, multi-billion-dollar market. So it's something that, although kind of undefined at this point, is something that I'm sure investors are excited about.
Eric, Amazon is in a race with Apple to that $1 trillion market cap. Do you think Amazon can get there first?
Actually, it's looking to be the case. Really, they have really just come out of nowhere. Now they're around 900 billion. I think today, after the earnings announcement, they're getting ever more closer to where they might cross over Apple's market cap and hit that $1 trillion number. It's a big number. They have a lot to prove here, and everything is priced to perfection, but they continue to deliver on that perfection year in and year out. And the stock is not without volatility either. We were looking back in 2015 when the market had a sell-off. Amazon was down almost 30%. And yet the stock just continues to plow forward and recover from those gains or those losses, and then go enter into new territory. Another thing that I think a lot of people are missing, and there's a ton of focus on it, but this AWS business is so much bigger than most people think. Blockchain, as a buzzword that keeps getting bounced around. Blockchain as a service, whether it's IBM or Microsoft or Amazon, they're all benefiting from this, and many of them are using AWS in their storage facilities.
Let's talk about the cloud business, Garrett, because we saw strong cloud growth with Microsoft, with Google, and so it must be that this pie is just expanding so rapidly, and Amazon is in the lead.
Well, exactly. And we had, one of the key questions of this tech earnings period was exactly that, and we have a pretty definitive answer. We saw Microsoft come out, very good results, and then the question was, well, maybe it's just Microsoft. Maybe they're taking more of Amazon's business than was expected, and then Google came out also with good results. Okay, it's Google and Microsoft, and now, we had Google CEO speaking about how this is something that's bigger than just that company, bigger than just Microsoft. Like Eric said, this is something that all businesses are looking to the cloud. They're jumping on, whether it's blockchain or just traditional retailers, whatever you have. They are going onto the cloud, and they are using products like AWS. With the big growth number, we saw that the pie is expanding for everybody.
Eric, let's talk a little bit about the ad growth here. I mean, there is so much optimism about Amazon becoming, one of the top 2 competitors in online ads, with Google being the top and Facebook being number 2. But of course, with Facebook's performance over the last 24 hours, maybe Amazon really does have a shot of surpassing Facebook, even if it is in, 3 to 5 years. How much potential do you see there?
It's one of those things that everybody always pulls out that famous quote of Bezos, where it's your margin is my opportunity, and that's really what we're seeing here. Is if there is a business that has wide margins and great success, and there's an entrenched incumbent, Amazon's coming for you, and this is kind of one of those classic examples, and they're perfectly positioned for that. They have 100 million Amazon Prime users, and that's not even to mention all of the others that are sitting on their site day after day, using it for shopping services. So they have those eyeballs. They might as well start monetizing them in ways, and not to mention all of the artificial intelligence that they have, and all the investment that they've made into that, so they can continue to just step forward farther and farther down that path. The next area, of course, is healthcare, and then we've got to watch out for financial services, but they're coming big.
On the call, Amazon continued to tout the efficiencies across cloud, across advertising, and across all of the operations. Eric, what do you think is Amazon's Achilles heel? I mean, at the risk of sounding overly glowy about Amazon, it's still a company that is turning, a profit, and a stronger than expected profit, but a smaller profit than some of its peers.
Well, that's the big thing, is that it's priced, again, trading at almost 300 times earnings. That's not a cheap stock by any means. Even based on the sector that it's in, it's almost 6 times the valuation of most of its nearest competitors. So any kind of hiccup, I see one could be political risk. We've seen Trump talk about their use of the Postal Service as really just its delivery boy, and I don't know if that's just banter or if that's actually something that could cause some pain for Amazon with wider margins or getting crushed. So if we see some political risk, it's going to hit the equity market immediately in the stock price, and you could see some massive sell-offs. The other thing is just, innovators sometimes fall off of their innovation wave, and as they stop innovating and they get more comfortable, then somebody else comes in and starts to take over, and then that stock, being priced at astronomical highs, starts to lose that luster and may never see that peak again. We saw that with Cisco, Dell. We saw that with a lot of companies in the late 90s, early 2000s, and they never recovered. So that's the biggest risk to an investor in Amazon right now.
Well, we are all waiting for that next presidential Amazon Washington Post Bezos tweet. Reality Shares CEO Eric Ervin and Bloomberg Tech's Garrett DeVink. Thank you both. President Trump waded into controversy over reports that Twitter is limiting the visibility of some Republicans on its platform. It is a known practice called shadow banning. The president tweeted on Thursday, quote, "Twitter shadow banning prominent Republicans. Not good. We will look into this discriminatory and illegal practice at once. Many complaints." Twitter shares dipped after that tweet. Still ahead, Spotify successfully fends off the competition for now. How the music streaming company is keeping Apple and Amazon at bay. This is Bloomberg. Spotify seems to be overcoming its Apple threat. The newly public company was out with earnings Thursday, and it gained more subscribers than expected thanks to customers in Latin America and emerging markets. Spotify boosted its customer base to 180 million in the second quarter, beating forecasts, and paid subscribers reached 83 million, more than any other music service. Spotify analyst Justin Patterson at Raymond James joins us now. He has a strong buy rating on the stock. So what do you think is really driving this subscriber growth?
Yeah, I think it's really a couple of things, Emily. First, you're still in the early phase of secular growth of streaming music. You've got a lot of devices like the Amazon Echo, the Google Home proliferating right now, and subscription has really gained more awareness with customers. So it's very early innings. People are shifting from a traditional purchase model to a rental model, and there's a lot of growth across the globe at this point in time. And Spotify is one of the beneficiaries.
We talk a lot about the subscription service, but that ad-supported free service is also a big driver. How big?
It varies from company to company. For Spotify, it's a very small bet today. It's about 10% of revenue. They actually missed a little bit this quarter due to some GDPR-related issues. But longer term, radio is a $25 billion market globally. There's a lot of room for Spotify to grow that.
Talk about the competition with Apple, and we're still waiting for Apple to report, but this is a company that obviously has really deep pockets and really long-term relationships with artists that Spotify has to compete with.
Right, it's a great question. Apple does have a platform advantage. It can push Apple Music out to all of the iPhone owners, the iPad owners in the market. That said, if you look at the global market, Apple really has a small market share relative to Android, relative to other devices, and that market share further fragments when you factor in that Amazon Echo is the dominant speaker. So when you look at what's going to be the winning factor for a streaming business, it's device ubiquity. Spotify's a Switzerland, it works on every device, and it's starting to build up this data advantage that I think is going to be really difficult for others to compete with.
But Amazon also has its own music service that it's trying to
It does.
push on users.
It does. They're all trying to push you. It's kind of a unique situation where Amazon, Google, and Apple are your competitive set, yet Spotify right now is the market share leader. And if I look at each one of those businesses, they do one device well, but not every device well. And none of them are really optimized to work on one another's devices. Spotify works great across every device in the marketplace, and that's one of the reasons it's been growing so rapidly.
Talk to me about the data that Spotify has and why it's so valuable.
Yeah, it's another really great question. So if I look at the way artists are compensated these days, it's more toward live performances and building up an audience. So what Spotify is doing with the Spotify for Artists initiative is bringing that data back to musicians, helping them grow their audiences. In this past quarter, I think Spotify increased audience listenership by about 5% for independent artists. That's something they can really start to build up over time and monetize, help artists be more successful.
So how does that differ from what Apple does and Amazon and Pandora?
I'd think of it really as being that data advantage is basically a function of Spotify's scale. With 180 million users around the globe, Spotify is multiples bigger than any other player in the market. And with that, it just consumes substantially more hours listened. Apple is still a subset of the market. Pandora only looks at the US. So if you're being a global player, trying to build a global audience, you need Spotify's data.
What are the trends we should be watching for in emerging markets and international markets?
Yeah, for the emerging markets, I think it's really just a function of market launches at this point in time. Spotify's mostly in developed markets right now. It was in 65 markets at the end of this past quarter. It's starting to launch in the rest of the world a little bit more. It did its first launch in Africa last quarter. So I'd really be watching just what exactly are the app download trends for Spotify. Is it getting partners to help push the device, push the application in those markets? And then what exactly is the price point? Because if you do go into the rest of the world, discretionary income gets a little bit less, so you need to price it accordingly for different markets.
And what about some of the additional content, non-music content that they're investing in, podcasts and the like?
I'd call that a long-term bet at this point. If you look at podcasts, you've got great engagement, but historically not too much monetization on those platforms. Oftentimes it's still somebody reading a spoken advertisement on there, and you don't have that same degree of ad targeting that, say, a Google or a Facebook gives you. So it's something that ad formats are still being experimented on. It's something that could be monetized a lot more over time, but I'd call that a 3 to 5 year driver versus, say, something you'll see in the next quarter's numbers.
All right, Justin Patterson of Raymond James.
Thank you
for stopping by. Coming up, investors may have been disappointed by PayPal's third quarter forecasts. Can the company maintain its competitive edge? CFO John Rainey tells us next. This is Bloomberg. Rising fintech player Stripe is offering a new product for its users, credit cards. Visa and MasterCard will be the card networks for Stripe's new business. The company has become a well-known name in payments by making it simpler for platforms like Lyft and Postmates to process them. We caught up with co-founder and president John Collison earlier this year on Bloomberg Studio 1.0 and talked about keeping the competition at bay.
We think all of those consumer payment methods like Apple Pay, like Google Pay, like Visa will all be really successful over time. But what has always been lacking is a platform for the businesses to just manage and abstract the complexity of doing business online in 2018. And then you look at what internet businesses are doing today, the business models are changing, they're much more global, they're often getting much more complex, like a multi-party interaction or something like that. And so that's what we're focused on, and that's why Apple Pay has been growing like a weed as a payment method, and that's phenomenal for Stripe.
While PayPal reported second quarter results that topped estimates Wednesday, investors weren't celebrating just yet. The digital payments company announced third quarter sales projections that fell short of analyst estimates with the slowing user growth of its mobile payment app Venmo and the company's new $10 billion stock buyback program. Investors are concerned about its competitive edge. PayPal CFO John Rainey caught up with Bloomberg's Caroline Hyde to talk about the report and future M&A.
we thought that we had a very good quarter and gave very good guidance for the year. We had, for the second quarter, reported 23% revenue growth and 28% EPS growth. And to your point, we also announced a $10 billion share buyback. For the back half of the year, we actually increased our revenue guidance by $100 million and increased our EPS guidance by 1 cent, showing the momentum in the business. And we're pleased with the progress that we're making. I think the quarterization of that is maybe a little bit misaligned with what Wall Street expects, and that's perhaps why you're seeing what you're seeing in the stock.
Are you concerned by Wall Street in general at the moment, John? I mean, what a day, a record-breaking day in terms of the move we've seen on Facebook. Do you think the market valuations, I mean, you've yourself seen your share price up about 80% last year, up about 24% so far in 2018. Does it just make it harder and harder to live up to these sorts of expectations?
Well, I can't predict what Wall Street is going to do or the stock price reactions. What I can do is focus on what we control at PayPal, and that's growing digital payments. We're growing at a rate that is 25 to 30% year on year, and you're seeing a lot of interest in digital payments and fintech in general because of the way that people are changing the way that they move and manage money. We're positioned very well at PayPal with having a two-sided network with almost 250 million customers on one side and 20 million merchants on the other, and I think that's why you see a lot of interest in our stock.
John, I mean, I'll dig into your numbers in just a moment, but you're sat in San Francisco. Facebook in times is a frenemy. You've sometimes been competitors and sometimes joined with them. Does it worry you by what's happened in the terms of their share price today?
Well, I can't speak to Facebook. What I can tell you is that we do partner with a lot of technology platforms and marketplaces. One of the things that we've done, we pivoted a couple years ago to where we have an open digital payments platform. And doing that, we want to partner with companies like Facebook and many other large technology platforms. But I can't speak to what's happening with Facebook.
You want to partner, you also want to buy. You're still saying that you're acquisitive. I saw you buy a pin-up of European fintech, iZettle, in the previous quarter, and you're still on the hunt for acquisitions. Where would be best place to invest at the moment, John?
Yeah, so our capital allocation strategy sort of has three pillars. One is investing organically, internally. Another is returning cash to shareholders. And lastly, going out and acquiring companies for growth. We've had pretty busy last quarter where we announced 4 acquisitions. And these are all acquisitions that really help the merchant side of our platform. And we want to be balanced and also focus on the consumer side. So as we look at opportunities around the world to go acquire different companies for growth, we want to make sure that we're continuing to offer capabilities that are very complementary to our platform for merchants. Things like risk as a service or payouts, which are things that the companies that we acquire do. At the same point in time, we want to make sure that we're going out and providing a consumer offering on the customer side that is very appealing to them and continues to provide services like our one-touch technology where they have a frictionless checkout.
Does it frustrate you at all when you're looking at merchants, when you're looking at, it's still 20% of online sales. I mean, do you need to get in with a partnership with Amazon? Would that occur? What's been delaying it?
Well, we'd love to partner with every large company in the world. As we look at the opportunities for growth around the world, one of the things that's very obvious to us is that we're under-penetrated in many markets internationally. We happen to have a very strong presence in the UK, but there are probably 5 or 6 core markets where we have our full suite of products rolled out. What we're very focused on is increasing our penetration among the digital users in some of these large international markets like in India or China or Mexico or Brazil.
International is a key focus. What also about the app, of course, Venmo? There was some concern about the slowing growth rate. I mean, the growth rate's still pretty stellar, and you're looking at 78%, but it has been slowing. How do you want to see Venmo continue to progress? And indeed, how do you start to make it more revenue generating?
Yeah, so Venmo actually had its best quarter for growth in terms of net new customers that we've ever had. We added more Venmo customers to our platform than we ever had before. If we look at our total payment volume, the annual run rate right now for Venmo is around $60 billion of TPV, of total payment volume. And that grew 78% in the last quarter. There are very few companies that I'm aware of that have that amount of payment volume that are growing at that rate. But to your point, one of the things that we're very focused focused on is monetizing Venmo. Today, Venmo is largely a P2P or a peer-to-peer application where you might be exchanging money with a friend or someone in your network. What we want to do and what we've moved towards in the last part of last year is to allow our Venmo customers to actually go shop at merchants. And that's very appealing to merchants because of the social aspect of this platform. It's akin to free advertising for them.
PayPal CFO John Rainey there with our own Caroline Hyde earlier on Bloomberg Markets. Now, a wrap of Amazon's second quarter results. The company missed estimates on revenue and the revenue forecast, but revenue growth from Amazon Web Services and advertising were both strong, and the company beat massively on earnings. The results and outlook show Amazon is managing to keep a lid on expenses while investing heavily in new devices and businesses like selling groceries and prescription drugs. Amazon CFO Brian Olsavsky spoke on the earnings call. Take a listen.
We had what I attribute it to is continued strength in some of our most profitable areas. AWS had its third consecutive quarter of accelerating growth, 49% FX neutral growth. Advertising also had strong growth. Elsewhere, we saw probably better than expected efficiencies in operations.
And that does it for this edition of Bloomberg Technology. On Friday's show, we're going to be breaking down Twitter's results. Can the company meet high expectations after turning around its performance this year? We'll discuss. This is Bloomberg.